This week, the markets can thank the imminent passage of the $2 trillion fiscal stimulus bill for boosting the U.S. stock market's double digit percentage gains this week. So, what is going to drive the markets up in the weeks ahead? Well, I have a whale of a tale to tell you. So, let's take a look. In the beginning of the crash, say a few weeks ago, the up volume was likely powered by short covering and rebalancing. Since then, the stock market recovery moved into another stage. This stage was likely propelled by market participants that have to buy regardless. I say this because there are buyers that represent pension funds and the so called balanced mutual funds. These buyers need to constantly rebalance their portfolios when stocks sell off or when there is a rally in government bonds. With the Chinese virus, the stock market has crashed while money chased the bond market looking for safety. Some pension funds, like Japan's Government Pension Investment Fund, have more flexibility of when they need to rebalance their assets. They can move now or wait several months. But then there are the balanced mutual funds like the so called 60/40 funds. These funds allocate up to about 60% of their holdings in stocks, and about 40% of their funds are allocated to bonds. These entities typically rebalance every month or two, but what we have coming up within 1 week is the month end and the quarter end. And with the monthly and quarterly end is a rebalancing. Estimates are that about $850 billion in mandated stock buying will take place. According to JP Morgan estimates, the balanced or the 60/40 mutual funds in the US and globally need to buy around $300 billion of equities to fully rebalance to 60% equity allocation. And at the same time, the $7.5 trillion universe of U.S. defined benefit plans will need to buy about $400 billion of stocks to fully rebalance and revert to pre virus allocation levels. But we should not forget that there are the balanced sovereign pension funds such as Norges Bank and GPIF, which also need to rebalance. Before the correction, these sovereign funds had assets of about $1.1 trillion and $1.5 trillion, respectively. According to JP Morgan, they need to buy about $150 billion of equities to fully revert to their target equity allocations. Reportedly, the Norwegian Sovereign Wealth Fund has lost about $124 billion as markets crashed. And according to the fund's chief executive, the fund is going to double down, meaning that instead of rebalancing to a level of about 65% stocks, the fund is going to raise its stock market investment back up to a level of about 70%. As a result, we may see this forced buying from these sources in the coming days. So watch for it. And for today, short but sweet. That's ChewDog Charts. Thank you.